Hello and welcome to this Market Outlook Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. And always, if you've got any questions related to these videos or comments, please leave them below and we will get right back to you. The idea of these videos are to help you become a better trader with lots of different examples of trades, tactics you can use, and outlook on the market. So with that, let's jump right into, in this case, a tutorial which I've called the easiest way to short the market, not because this is always the easiest way to short the market, but at certain times it's just a lot easier to get exposure to be short the market, in other words, profit from the market going down, than to go right out and literally short the SPYs or buy the reverse ETFs. And the reason there may be a different way to do it is simply because when the market's coming off a high, as it is right now, it's very easy for the market to have wild gyrations, both up and down. So the idea here is essentially that we've broken this support line that I've got here on a horizontal basis, and we've rolled under the 10. And if you want to take the position that the market could sell off here, which is my position currently, then you could be short and look to get short the SPY. But right now there's an easier way to basically profit if the market goes down. And perhaps, while nothing is guaranteed, not get as hurt if the market starts to head higher. And here's what I mean. Because the market was at a high, the VIX was at a low. So if we take a look, I want to compare and contrast the VIX here to the SPYs, right? So without a full lesson on the VIX is going to tend to go up when the SPYs go down. The fear gauge, the premium people pay for options goes up when the market starts to fall down. Now, the thing here is that the VIX is not always the easiest way to get short the market. The time to get short the VIX, the time to buy the VIX to short the market is when the VIX is extraordinarily low. When the VIX is high, then you have the opposite effect. The opposite effect is that the VIX could actually come down even if the market doesn't go up against you. So you could be right in the market coming down and still lose in the VIX. But the current situation with the VIX is the opposite. And the reason I'm doing this video today is you can see in the daily action how this worked out. So if you were long the VIX coming into the day and you had your stop under the day's low, then you never were in any kind of risk of being stopped out. But if you were short the S&Ps coming into this day, you would have gotten stopped out near the highs, assuming that was your stop. Now, I'm not suggesting that's exactly how you should trade with your stops, but the reason I'm saying this is easier to be short is because the VIX right now is just getting going on the upside because it's responding to increased volatility. So as long as there's increased volatility up here in the SPYs, VIX is going to tend to stay up. So when the market rises, as long as the market isn't convinced that now it's time to go back to new highs, there's a good chance VIX is going to remain high for at least a day or two. So it gives you extra time to be short the market without any particular without risking as much of getting stopped out. So let's take a look at the intraday action here, and you can see how this worked out as well. Okay, so let's just take a look at how both of these instruments traded. So the SPYs, this is the SPYs yesterday. They opened higher. They ran up. This is the high from the prior day. And they kind of consolidated near the high of the prior day. This is the opening range high. So if you're an opening range trader, you're going to be focused on that level. And if you do the same thing in the VIX, but the opposite, the VIX opened lower in response to the SPYs opening higher, and then traded down nowhere near the prior day's low, right? In fact, it just was sitting right on top of good support from the day before. So if you were looking to get short the SPYs against the highs with an opening range breakdown, that would have been a good idea in terms of a trade for a bearish trade. The same trade would have been to buy the SPYs through its 30-minute opening range low with a stop below the low of the day. If you that same trade would be essentially betting the same thing, but look at how the rewards worked out. So the SPYs had a nice drop, right? But it just barely got down to in fact, it didn't even get down to the close of the prior day. It didn't get anywhere near the low of the prior day. But the VIX exploded. The VIX exploded through the close of the prior day and through the high of the prior day. And so you can see that again on the daily chart, which is where I started. So if we go back to the daily chart, there's an unusual, and when I say unusual, it's not always the case. There's a unusual situation where if the VIX is really low, you have an advantage in getting short the market by using the VIX rather than by using the SPYs for two reasons. One, if you're right, the VIX is more likely to move more. And two, if you're wrong, and I say wrong, meaning the market starts to head higher, you can see the VIX, just the added volatility and uncertainty because the market's rolling over, keeps the VIX high. All right, so the VIX is one way you can do this. If you noticed on my screen before I shuffled it all around, I'm looking at the markets currently like this. I have the SPYs, the Qs, the IWMs as a sense of which way the indexes are going, and then I have the VIX, and then I have TLTs, bonds. So I won't get into bonds right now, but bonds are another way you can, at certain times, essentially put on a short bet against the stocks and not have the same level of risk and maybe potentially even have more upside. So I'm going to finish with one last chart, and this is a chart we show you almost every week in the weekly market outlook that Keith usually does. I happened to do it last weekend, but we both make sure that we cover some of the same indicators, especially if it's relevant. So the best time to do this is when you've got the VIX. Now this is a different chart of the VIX. This is actually the cash index of the VIX, and we've got Bollinger Bands on it and a 50-day moving average and a 200-day moving average. The key here is that when the VIX comes down to the lower Bollinger Band, it tends to be an extreme. It doesn't mean it's a big market top, but it does mean the market's a little too complacent in the short term. And if at that time you're looking to I find a short trade on the market, then the VIX is probably a better way to do it. The time to not get short with the VIX is when the VIX has already exploded. All right, so you can see here that at this high, the VIX hit the low and the market came off a little bit. It turns out that wasn't the top. Market went back up, VIX rallied back up, but then the VIX came right back down to the lower end of the Bollinger Band. So again, basically, this is the time you want to look to do exactly what I'm talking about. So keep your eye on that. Keep your eye on our weekly video, and we'll be sure, as we always do, to let you know when this condition exists. And now you have a way that you can get short the market with in a way that gives you an edge if you're right and less risk if you're wrong. Hope that helps. We'll see you in the next video. And again, please leave any comments you may have below.